This video, we will talk about the second factor, that we will consider when we relax the assumptions of Modigliani and Miller, and that's financial distress. Okay? In Modigliani and Miller, this is the perfect capital market. We did not assume default scenarios, okay, for the risk of default. In this case, let's consider the impact of financial distress. And what is the impact of the fact that there is financial distress? What's the impact of that on the capital structure decisions of a firm? Okay. So what is financial distress? Financial distress is when a firm has difficulty meeting its obligations. Okay. And in terms of default, there is default when the firm fails to make the required interest or principal payments. So distress is difficulty. Default is the actual failure to pay interest or principal in its obligations or when it violates a covenant. Okay. So after the firm defaults, debt holders are given certain rights on the assets. So they can seize the assets, pwede nilang i-remata, pwede nilang i-benta yung assets to fulfill the obligations. Okay. So an important consequence of leverage is the risk of bankruptcy. If there is no debt, okay, walang obligation to pay someone a certain amount, right? And therefore, there is less risk of bankruptcy, right? Kasi wala namang lenders or creditors who will be there to check on the operations and to seize the assets when you don't pay. Okay? Equity financing does not carry that risk. Okay? And therefore, as you add more debt, the risk of bankruptcy increases. Now the question is, does the increase in risk of bankruptcy affect firm value? If it does, then leverage affects firm value, contrary to Modigliani and Miller. So that's what we're going to explore in this presentation. Let's consider two scenarios. So Armin is a company considering a new project. So although the new product represents a significant advance over Armin's competitors, the product success is of course uncertain. If it's a hit, the revenues and profits will grow and Armin will be worth 150 million at the end of that year. If it fails, the company will be only worth 80 million. Okay? And the Armin may employ one of two alternative capital structures, all equity financing or there's debt. Okay? Debt worth 100 million. Okay? So let's try to analyze each scenario. For the first scenario, if the product is successful, Armin is worth 150 million. Without leverage, that full 150 million will be paid to equity holders. That amount in full will be provided to equity holders. With leverage, what happens is that 100 of the 150 million debt will be paid out to creditors. The remaining 50 million will be paid to equity, right? Okay, or to the owners of the firm. Now, with perfect capital markets, there's no issue with that. As long as the value of the firm's assets exceeds its liabilities, Armin will be able to prepay the loan. If it does not have the cash available, it can raise that cash by obtaining a new loan or issuing of shares. So just a review that in perfect capital markets, then it need not default on these obligations as long as the market value of the assets exceeds its liabilities. And it can always raise that money through the capital markets. Now, if scenario two, the new product fails without leverage, equity holders will lose 20 million, right? Uh, because it used to be 100, right? Okay. So now it's only worth 80. So therefore, they lost value of 20 million, right? With leverage, Armin will experience financial distress. So the firm will default kasi the value of its assets is higher, is lower than the value of the debt, which is 100 million. Okay. So in bankruptcy, debt holders will receive legal ownership of the firm's asset, and the shareholders will receive nothing. Because the assets the debt holders will receive has a value of 80, they will suffer a loss of 20 million. Okay. So in other words, parang nare-apportion lang, right? Pag without leverage, yung 20 million loss is with the equity holders. With leverage, that loss was transferred to debt holders, 20 million. And effectively, parang sila na yung may-ari ng assets. So parang na-shift yung ownership from equity holders to debt holders. So that's what happens in a perfect capital market. Okay. So if you compare the two scenarios, without leverage, if the product fails, equity holders will lose 70 million. Okay. And that's the difference. And that's this difference, 150 to 80, right? If it's success or a failure. With leverage, equity holders lose only 50 million. Okay? Paano yan? Before, this loss is 70 million. But here, this loss is now only 50 million. What happened to the 20 million? Debt holders also um, lose 20 million. Okay? So, 70 million pa rin yung total. And this is under perfect capital markets. Okay? Na-reapportion lang yung risk. The total value remains the same. Okay? So now, with perfect capital markets, Modigliani and Miller Proposition 1 applies. The total value to all investors does not depend on the firm's capital structure. Okay? They share the losses. The pie is the same size and was just allocated to two parties rather than one. And there is no debt advantage to debt financing, and a firm will have the same total value and will be able to raise the same amount with either capital structure. Now, let's suppose uh, that let's look at this problem. Suppose that the risk-free rate is 5% and Armin's new product is equally likely to succeed or fail. For simplicity, suppose the Armin's cash flows are unrelated to the state of the economy so that the project has a beta of 0. Okay? And the cost of capital is the risk-free rate. Okay? Compute the value of Armin securities at the beginning of the year with and without leverage and show that Proposition 1 holds. Okay? So without leverage, the equity is worth either 150 million or 80 million, and it's equally likely, right? So therefore, you can get the expected uh, value of equity. That's 50% probability for each one. And then you can discount that because that is the value after a year. Discounting it 5%, we get the amount equal to 109.25 million. So here, this is the 50% probability of success, 50% probability of failure, get the present value. Okay. With leverage, so that is the value of the unlevered equity, which is equal to the value of the firm. Okay. With leverage, what happens? No? With leverage, equity holders receive 50 billion or nothing, right? And discount that, you get 23.81 million. Okay. With leverage, debt holders receive 100 or 80, and thus they receive 85.71 million. Okay. And therefore, if you look at this, okay, this is equal to 109.52 because equity here is valued at 23.81, debt is valued at 85.71, which is equal to 109.52. So it shows that Proposition 1 holds. Okay. Now let's try to soften the assumption of MM1 by assuming bankruptcy costs. Okay. Now, with perfect capital markets, the risk of bankruptcy is not a disadvantage of debt. Rather, bankruptcy shifts the ownerships of the firm from equity to debt holders without changing the total value. Yun yung nangyari kanina. Like, pag nag-default, maririmata ng equity ng debt holders yung assets. So, in effect, parang sila na yung may-ari ng assets. Right? Kasi yung naging value ng equity, 0. Napunta sa kanila yung buong 80. Right? But in reality, it's not as simple as that. Bankruptcy has its cost. Okay? And that cost may affect firm value, right? And so therefore might impact capital structure decisions. Okay. So direct costs. There are direct costs of bankruptcy because the bankruptcy process is complex and time consuming. So there's the cost of experts, cost of appraisers, cost of lawyers, no, and therefore the presence of bankruptcy results in outflows for the firm, expenses for the firm to pay, and since it results in outflows for the firm, then it reduces the firm value, right? No, kasi may kailangan bayaran eh. Okay? Eh dati hindi binabayaran yan under perfect capital markets. Okay? So the direct costs of bankruptcy reduce the value of the assets that the firm's investors will ultimately receive. And since it reduces assets, then it reduces firm value. And therefore, the higher the debt level is, the higher is the risk of bankruptcy. And therefore, the higher are the possibility that these bankruptcy costs are going to be incurred. And therefore, the lower the firm value will be. Okay? In the US, the average cost of bankruptcy is approximately 3 to 4% of the pre-bankruptcy market value of total assets. Okay? The bigger cost of bankruptcy is not the direct cost. The bigger cost of bankruptcy is the indirect costs of bankruptcy. Okay? Pag naging bankrupt ang isang company, pwedeng hindi na siya makabangon. Right? And therefore, the value of its assets reduces sharply. Okay? Why is that so? Number one, there could be loss of customers, suppliers, and employees. Why is that the case? Eh, kung bankrupt na yung isang company, will you still deal with that company? So all of a sudden, you will lose customers, even though you can still operate very normally, kahit na under bankruptcy ka, right? You don't, I mean, customers, suppliers, and employees don't want to be associated with a bankrupt company. No, so definitely there will be a decrease in cash flows because of this, and therefore there will be an increase in firm value, right? And therefore bankruptcy cost decreases the firm value, and bankruptcy cost arises if there's more debt, right? It's the borrowers, it's the creditors who have the right to declare right over those assets, and the borrower will be forced to declare bankruptcy because of it. Okay, loss of receivables. Some of your receivables might not want to pay. No, I mean, lugi na pala yan eh. Huwag na nating bayaran. No, hanap na lang tayo ng ibang supplier, right? Fire sale of assets. Upon liquidation, or when assets are being sold to satisfy the debt, no, pag minsan time is of the essence. So rather than finding the highest price available, the bank might say na okay na dyan, ibenta mo na dyan, fire sale na lang para lang masatisfy yung kanyang debt obligation. And therefore, the value of the firm decreases. Okay? Costs to creditors, of course, no? And delayed liquidation. The delay can cause additional expenses. No? And therefore, these indirect costs of financial distress may be very substantial. And that's the one that actually reduced value the most. So, in the US, it's around 10% to 20% of the firm value. So in other words, we're now trying to make a connection between the level of debt and the level of bankruptcy cost. Of course, the higher the debt levels are, then the more payments must be made to creditors. And since the more payments must be made to creditors, you will be under higher chances of financial distress. And since the chances or the probability of the financial distress is high, the probability or the expected value of this bankruptcy costs will also be high. And that reduces overall firm value. Okay. So when estimating indirect costs, two important points must be considered. There's a loss to the total firm value, okay, and not solely losses to equity holders or debt holders or transfer between them. The losses to the total firm value must be identified. Okay. And the incremental losses that are associated with financial distress above and beyond any losses that could occur due to the firm's economic distress must be identified. Okay. Because there are economic reasons for distress, but there are also financial reasons for distress, for those arising because of the presence of debt. Okay? So therefore, financial distress costs reduce firm value, and this reduction is leverage driven. Thus, leverage may reduce the firm value, thereby with bankruptcy costs, the value of an unlevered firm is greater than the value of a levered firm plus the present value of the tax shield. Okay? So in other words, nababawasan yung firm value, no? Nababawasan yung value of a levered firm because of the presence of bankruptcy cost. Let's look at this. So same Armin Industries, no? With an all equity financing, ganun pa rin. Assets will be worth either 150 or 80. No, if with debt of 100 million, Armin will be forced into bankruptcy if the new product fails. Okay, so in this case, when it fails, the value of the assets will be lost to bankruptcy, and the debt holders will receive less than 80. Why? Because they have to account for the cost of financial distress. Okay, let's assume that the debt holders have already received 60 because of that. Okay, so without leverage, the reduction in value is 70. With leverage, the reduction in value is 90. 50 absorbed by equity, 40 absorbed by debt. Saan nanggaling yung difference na 20? Because of the financial distress costs. Okay? So even though income tax increases the value of a levered firm as debt increases, but it also adds on to bankruptcy costs, which may offset the gains of income taxes, okay, or interest tax shields, okay, due to the presence of distress costs. So let's look at this. So compare the current value of the company with and without leverage. Assume that the risk-free rate is 5% and the new product is equally likely to succeed or fail. So let's compute for it. No, with and without leverage, the payments to equity holders are the same. No, there we compute the value of the unlevered firm as 106.52. So yun pa rin ang VU. That's how much? 106.52. We are trying to compute for VL. Okay? And here what we'll do is compute VL as equal to value of equity plus value of debt. Okay? So how do you now compute the two? What is the value of debt? E di ganun din, we get the present value of the cash flows of debt. Okay? What are the cash flows of debt? Okay? If the product succeeds, he'll receive 100, which is the whole amount of the debt. If the product fails, he'll pay 60 to consider the bankruptcy cost of 20. Okay? And therefore, the value of debt becomes 76.19. Okay? Now, the value of equity is the same as the previous ones. Value of equity is 1/2. He'll receive 50 if it succeeds, 1/2, 0 if it fails, and get the present value. And this is equal to 23.81. Okay? With that, okay, the value of the levered firm is 100 million, which is less than the value of the unlevered firm. Okay? The unlevered firm is 106.52. And that difference is due to the fact that there was a 20 million bankruptcy cost. So if you get the present value of financial distress, if the company, if the product succeeds, there is no distress cost. If it fails, there's a 20 million distress cost. Get the present value of that at the probability of 50%, it's 9.52. And that's the present value of distress cost. Okay. Sorry, I think this is 109.52 rather than 106. Para 9.52 yung difference. Okay? Alright. Now we go to the theory of the optimal capital structure, and that is the trade-off theory. Okay? The trade-off theory is the main theory of capital structure that says that there is an optimal capital structure. Okay? So the firm, it says that the firm picks its capital structure by trading off two things. They are trading off the benefits of tax shield from debt against the cost of financial distress. Kaya siya trade-off theory. Kasi as you increase debt, the benefit of tax shield increases, but the cost of financial distress also increases. So, nagkakaroon ng optimal capital structure ang isang firm because nakukuha niya yung right balance between the tax shield from debt and the cost of financial distress that maximizes the total value of the firm. So, formally, according to the trade-off theory, the total value of a levered firm equals the value of the firm without leverage plus the present value of tax shields less the present value of financial distress cost. And these two have opposing signs, right? As debt increases, the present value of tax shield increases. But as debt increases, the present value of distress costs increases also. And the sign is negative, right? So you have to strike that balance between the two. And when you strike that balance, you have arrived at the optimal capital structure. So that is the trade-off theory. Okay, let's further discuss. Okay, distress costs. Okay, what are the factors to consider in trying to determine the value of distress cost? Okay, number one, you need to get the probability of distress. Okay, right? Kasi for you to get the present value of something, okay, you need to get the amount. Ano lang yan eh, magnitude times probability to get the expected distress cost. But you need to get the present value. So you need to discount it at a discount rate. So those are the three things that you need to consider in valuing distress cost. How much is the magnitude? What is the probability? And what is the discount rate? Okay. So the probability of distress increases with the amount of the firm's liabilities relative to its assets and with the volatility of the firm's cash flows and asset values. Okay. When is a company in distress? A company is in distress if its assets, okay, is less than its liabilities. When assets is less than debt, okay. If you're trying to determine the probability of financial distress, what do you need to check? Okay. So if liabilities are high, then liabilities, the value of liabilities, medyo malapit na siya sa value of assets. Right? Because remember, asset equals liabilities plus equity. Right? So as liabilities increase, the proportion of assets funded by liabilities also increase. And the gap between the two is narrower. And since the gap between the two is narrower, the probability that assets will be less than liabilities is higher. And therefore, the probability of financial distress is higher. Okay? It's also a function of the volatility of the firm's cash flows and asset values. Okay? Remember, pwede kasing constant yung liabilities pero malaki yung fluctuation in your asset base. So if your the value of asset base fluctuates quite on a wider range, then the chance that your assets will be lower than liabilities is high. Therefore, there's higher probability of financial distress. Okay. Second, magnitude of financial distress. The magnitude or the amount that you're going to pay depends on it varies by industry. No? Bakit? Merong mga assets na madaling ibenta and therefore the cost of financial distress will be lower. Meron namang assets na sobrang specialized, mahirap ibenta, right? And so therefore, there could be high distress costs related to it. At mahirap isettle yung debt kasi mahirap ibenta yung assets in the first place. So for example, here, technology firms will likely incur higher financial distress costs due to the potential for loss of customers and key personnel, as well as lack of tangible assets that can be easily liquidated. Okay? Contrast that against a real estate company. Low ang financial distress cost nun kasi yung mga lupa, condominium building, madaling ibenta yan. Right? And therefore, transaction costs will be low. Distress costs will be low. Okay? So, the magnitude might depend on the nature of the company. And then the appropriate discount rate for distress cost, of course, it depends on the firm's market risk. Okay? So, it depends on the, okay? So, that's the main characteristic. Okay? So the present value of distress cost will be higher for high beta firms. Okay? Kasi the required rate of return will be higher. Okay? So I think the main message here is that it's also impractical to value distress cost, right? I mean, it's really difficult to do that because it's difficult to pin down the probability of distress. It's difficult to pin down the magnitude. It's difficult to pin down the discount rate. Okay? So mahirap siyang computein ano yung actual optimal capital structure. Unlike NPV, right? Whether invest go or no go sa investment, positive NPV go. Right? Dito, yung optimal capital structure is based on variables that are very difficult to quantify. Right? And a little bit theoretical. So that's why there's no a go, no go decision in terms of debt. It's really an art on how the optimal capital structure is determined. Okay, and we'll build on that as we go along in this presentation. Okay, so for optimal leverage, theoretically, this is how it goes. No, so let's look at the graph first. So the dotted line, this one, the dotted line here. Okay, this is the value of the unlevered firm. Okay, with taxes. Okay, value of a levered firm with taxes. Okay, so here is the value of the unlevered firm. Okay, as we increase debt, the value of the firm increases because of tax shield. Okay, and that's this portion. Okay. However, as you increase the proportion of debt, what happens? Distress cost at some point will set in, okay, and will slow down the benefit of financial distress, and eventually it will be so strong that it will offset the benefit of the tax shield. Okay, and with that, you're able to determine an optimal capital structure. Okay, which is the point where the value of the firm is at its highest. Okay, and it is at the point where the value of the firm is maximized. Okay, now distress costs may vary between industries. So there are industries with high distress costs, and therefore the point where the tax shield advantage is offset sets in at a lower debt to equity ratio. So example yan, tech firms, high distress cost, so they will be um, parang their optimal capital structure will be at low debt levels. Okay? A real estate company, okay, very little distress cost. Okay? So mas mataas na debt level ang kaya nilang i-tolerate. Okay? At the maximized level. Okay? Now, what's the value of leverage? If there is no distress cost, mayroon pa ring optimal dito, right? Kasi remember, yung lesson natin kanina on tax shield, no? If there's excess interest, there is also loss in value through the tax shield. All right? So meron pa ring sort of optimal and it's very high leverage levels. Okay? Now, some notes. For low debt levels, here, okay, the risk of default remains very low and probably mababa pa ang probability of distress kung ganito pa lang kababa ang debt levels mo, right? But as your debt levels increase, the probability of distress becomes higher. The expected value becomes of your distress cost becomes more pronounced and it offsets some of the benefits from leverage already. And to the point that it is higher than the benefit of tax shield. And so therefore, hindi ka na dapat mag-go beyond that. Dito ka na lang kung saan maximized ang levered firm value. Okay? So as the level of debt increases, the cost of financial distress increase and sinks in and reduces the overall value of the firm. So the trade-off theory states that firms should increase their leverage until it reaches the level for which the firm value is maximized. Okay? So at this point, the tax savings that results from increasing leverage are perfectly offset by the increased probability of incurring the costs of financial distress. Okay? And this is the trade-off theory. Okay? So the trade-off theory says that there is an optimal capital structure. Okay? And it is a balance, no? Affected by what? Okay? Affected by tax shields, affected by distress costs. What affect distress costs? Probability. The higher the debt, the higher the probability of distress. Okay? What affects the magnitude? The nature of the industry, no? And what affects the discount rate? The beta. Higher beta, no? Uh, means it's more volatile, and therefore the higher is the distress cost. Okay? So those are considerations. And if you look at these considerations, most of them are qualitative considerations, and we cannot really pinpoint it. Tax shield, we can pinpoint it, we can compute that, right? Pero yung probability of distress, hirap gawin yan. The magnitude of distress, hirap estimate yan, right? So you really have to um, approximate it, no? Or um, yeah, you really have to approximate it, and hopefully through the empirical readings that we will discuss later on, it gives you an idea of what are the markers of the probability of distress costs. What are the proxies that we can look at to determine whether our probability of distress cost is high? What are the proxies for magnitude? And we'll see that in the empirical articles that we're going to discuss. Okay, so that's the trade-off theory. Okay. Aside from distress costs and in tax shield, related to interest, one aspect that impacts the firm value of a levered firm, okay, is agency costs. What are agency costs? It is the cost that arise when there are conflicts of interest between the firm's stakeholders. For example, management and shareholders. Okay? Usually, of course, the management is the agent of the shareholders, right? They were appointed by the board, and the board was voted upon by the shareholders, right? Supposed to be management is representing or doing its role to further the objectives of the shareholders. Okay, so dapat they're on the same team, management and shareholders. However, when a firm has leverage, okay, managers may make decisions that benefit shareholders but harm the creditors, or vice versa. It might harm shareholders and benefit creditors, and therefore it can make the total value of the firm lower, and therefore impact distress costs and impact the value of the firm in general. Okay, and these are agency costs that arise due to leverage. Okay, there are two primary agency costs related to leverage. Number one is excessive risk taking and asset substitution. And number two is debt overhang and underinvestment. Okay, let's discuss each one. So, excessive risk taking and asset substitution. Let's consider this one. The company is facing financial distress. Okay, so Baxter has a loan. Let's mark it. Baxter has a loan, 1 million due at the end of the year. Without a change in its strategy, the market value of its assets will only be 900,000 at that time, and therefore it will default on its debt. Okay, so they are already in the possibility of financial distress. No? If they don't do anything. Now they're considering a new strategy. So this new strategy requires no upfront investment, but it has only a 50% chance of success. If the new strategy succeeds, it will increase the value of the firm's asset to 1.3 million. If it fails, the assets will fall to 300,000. Okay. So if you look at the expected value of the firm's assets under the new strategy, 50-50 chance of success, the expected value is 800, which is a decline from 100,000 from the old strategy. Okay. But so therefore, if you're being rational, okay, you should not pursue this new strategy, right? Why should you not pursue this new strategy? Eh, kasi the present value of the new strategy for the expected value is 800. 900 na nga lang ako eh. Nalugi pa ako ng 100 under expected values. Right? Okay. However, what Baxter did was despite the negative payoff, tumayo na tayo. Tumaya na tayo. Kasi pag tumaya tayo, our asset value will be 1.3 million and we can repay the debt. Okay. So go ahead with the new strategy because there's a chance that we will succeed. 50% chance. Although the expected value is lower, but there's a chance that we'll get 1.3, so we can pay the debt, right? Now the question is, can shareholders benefit from this decision? Who will actually lose in this scenario? Okay, let's look at this scenario. So if Baxter does nothing, it will ultimately default, right? And equity holders will get nothing, okay, with certainty, okay? Equity holders have nothing to lose if Baxter tries the risky strategy. Kasi currently the assets are 900,000, liabilities is 1 million. So the payoff is for debt holders, the payoff is 900,000. For equity, zero. So ang base case nila zero eh. Meron pa ba silang easy zero? Hindi naman sila mag-negative eh. So that risky strategy actually has no impact to the shareholders. No? But if the strategy succeeds, equity holders will receive 300. Kasi magiging 1.3. So bababayaran yung 1 million, right? Yung equity, 300. Makakatanggap sila ng 300,000. So if you look at this, parang nangyari, no? No lose scenario ang equity in this new strategy, right? Ang current scenario nila 0. If they fail, equity will receive nothing, which is the same as the current scenario. But equity may win 300 if it is successful. So ang tinataya nila dito is actually the debt holders, right? The debt holders are going to lose more, no? They are going to lose 100,000. Okay? So mas maraming at risk ang equity dito, ang debt dito. Okay? So equity holders gain from this strategy even though it has a negative expected payoff while debt holders lose. Okay? If project succeeds, debt holders are fully repaid. They will receive 1 million. If project fails, they only receive 300. Sorry, 300,000 lang pala pag fail. Okay? Right? So, ang payoff ng debt, 650. Pero ang payoff ng equity is what? What's the payoff of equity? 150. From 0 to 150. Okay? For debt, from 900 to 650. So, yun yung difference sa 300,000. Okay? So, luging-lugi ang debt holders here. Okay? And here's where the agency cost comes in. Okay? Management might be incentivized to take on this excessive risk, okay? Because the shareholders will not be affected by it. Parang ang nire-risk talaga nila na assets ay yung assets na mapupunta sa liability or to the debt holders. Okay? So effectively, equity holders are gambling with debt holders' money. And because they pursued a project with a negative expected payoff, the firm value will decrease as a result of um, this issue. Okay. If they don't have leverage, magkakaroon ba ng excessive risk taking? Hindi. Bakit? The 900,000 will go to equity holders. So they will not feel the need to risk that money, no? Because mapupunta sa kanila yung buong 900,000 under the status quo. Right? So hindi nila kailangang mag-gamble because wala naman silang obligation to pay anyone, right? And therefore, they will be strictly looking at their own interest, no? Which is dapat ma-maintain yun ng 100,000. So if the expected value is 850 rather than 900, edi wag tayong tutuloy. Kasi yung mapupunta sa shareholders, bababa. Okay? Ang problema, yung mapupunta sa shareholders under this scenario with debt, tataas. Right? And remember, it's the shareholders which control the firm. So the decisions is for the shareholder. There'll be some conflict of interest there. And that conflict of interest here is what's called excessive risk taking. No? And so, therefore, the presence of debt may reduce the value of the firm if management will think about these kinds of strategies just to pay debt. Okay? So, aside from excessive risk taking, an issue that's related to it is called the asset substitution problem. So, ang ibig sabihin niyan is when a firm faces the financial distress, shareholders can gain at the expense of debt holders by taking a negative NPV project if it is sufficiently risky. They will take their chance on a negative NPV project kasi pag yung kasi kung yung kasi remember, yung negative NPV na project na yan, expected value lang yan. So because it's expected value, there is a possibility or probability that the result will be higher than that expected value. And if the result is higher than the expected value, then the benefit redounds to the shareholders. Diba? Pero kung lugi yan, lugi yan, ang tinaya talaga nilang pera ng debt holders because debt will receive less. Okay? Shareholders have an incentive to invest in negative NPV projects that are risky, even though a negative NPV project destroys value for the firm overall. And in anticipating this bad behavior, security holders will pay less for the firm initially. Okay? So therefore, it affects the expectation about the cash flows of the firm since leverage is there. So therefore, firm value will decrease. A second issue is debt overhang. Okay, let's discuss what debt overhang means. Now assume that Baxter does not pursue the risky strategy, but instead the firm is considering an investment opportunity that requires an initial investment of $100,000 and will generate risk-free return of 50%. Okay, if the current risk-free rate is 5%, the investment is clearly positive NPV. The IRR kasi is 50, right? IRR is 50, and the hurdle rate is 5%. So clearly it's positive NPV. Okay. Now, what if Baxter does not have the cash on hand to make the investment and they could raise 100,000 pesos in new equity to make that investment? Okay. So let's analyze what's happening without the new project and with the new project. Without the new project, you have existing assets of 900,000. Okay. The debt total firm value is 900 and the debt value is 900. Okay. There's no equity value. Okay. With the new project, this is the existing assets, magkakaroon ka ngayon ng isang project wherein the present value of the cash flow is 150. Saan nanggaling yan? 100,000 plus the 50% return, right? So therefore, the value of that project is 150. So the total firm value is 1050, right? And since there's debt of 1,000, okay, or 1 million, there's debt of 1 million, then 1 million will have to be paid to debt holders. So 50 will redound to equity holders. Okay. Now let's go to the next. Now, if equity holders contribute 100,000 to fund this project, okay, they only get back 50,000. Okay. So from the point of view of the the shareholders, bakit ganun? Nag-invest ako in a positive NPV project, pera ko yan, right? I funded 100,000 out of equity, but I only get back 50,000 in terms of value. Okay? And why is that the case? Kasi 100,000 napunta sa bayad ng debt, right? So, debt overhang simply means equity holders may choose na, ay, wag na lang tayo mag-invest. Kasi hindi naman, parang lugi ako sa result. I invested 100, but I will only get 50,000, right? Lugi ako sa arrangement kasi makupunta sa debt holders yung 100,000. Okay, so let's pass up on this project. I don't want to invest in this NPV opportunity. Okay, because it is a negative NPV investment opportunity for equity holders, even though it's a positive NPV opportunity for the firm. So that problem is called debt overhang or the underinvestment problem. Okay, so it's a situation in which equity holders choose not to invest in a positive NPV project because the firm is in financial distress. And it is the debt holders who will benefit if that positive NPV project happens. Okay? So, because the opportunity will accrue to bondholders rather than themselves. So, kabaliktaran siya nung excessive investment. Diba? Yung excessive investment in risky assets is that, sige, may konti pa tayong pera, i-shoot mo na dyan sa risky project. After all, ang mas malulugi si bondholders rather than, right? And because of that behavior, the firm value may decrease, right? Because the present value of that risky project is NPV negative, right? So therefore, firm value decreases. Therefore, leverage, the presence of leverage decreased firm value. In this case, because because the benefit of the new project will accrue to debt rather than equity. Sasabihin ng equity, huwag na tayo mag-invest sa positive NPV project na yan. So hindi to lumalaki ang firm value. It would have been higher but it remained at its current size or current magnitude for the firm value. So therefore, nakabawas din ng value yung agency cost na yun, right? And so that's why when a firm faces financial distress, it may choose not to finance new positive NPV projects, therefore impacting the firm value. Okay. So in estimating that overhang, we check how much leverage must a firm have for there to be a significant debt overhang problem. Okay. Now suppose equity holders invest an amount I in a new investment with similar risk to the rest of the firm. Equity holders will benefit from the new investment only if this happens. Okay. NPV of the project over investment is greater than the beta of debt times debt divided by beta of equity times equity. Okay. If this amount holds, then equity holders benefit from new investment and therefore lower um, probability of debt overhang. Okay. Uh, and therefore lower probability of debt overhang. Okay, so leverage can encourage managers and shareholders to act in ways that reduce the firm value. Okay, so it appears that equity holders benefit at the expense of debt holders. No, and ultimately the firm value decreases because of this. Okay, so when a firm adds leverage to its capital structure, the decision has two effects on the share price. The share price benefits from equity holders' ability to exploit debt holders in times of distress. And the debt holders recognize this possibility and pay less for the debt when it is issued, reducing the amount the firm can distribute to shareholders. Okay. So in other words, agency cost, these agency costs affect the firm's value. And these agency costs are there because of leverage present in the capital structure. No? So therefore, leverage impacts firm value. And therefore, leverage must be considered in capital structure decisions. Now, the magnitude of agency cost also depends on the maturity of debt. Okay, agency costs are higher for long-term debt and smallest for short-term debt, of course. Kasi syempre, kung mas matagal yung debt, then mas matagal yung opportunity for management to exploit debt holders. Okay, and that's why debt covenants are in place. So covenants are conditions of making a loan in which creditors place restrictions on actions that a firm can take. And the idea behind covenants is that covenants help reduce agency costs. Okay. Um, so supposed to be the covenants are there to keep them in check. Okay. However, of course, there's an issue because it may hinder management flexibility and covenants in itself may has the potential to prevent investment in positive NPV projects. So it's not a perfect way to reduce or eliminate agency costs. It can reduce, but definitely not eliminate agency costs. Now, if there are agency costs related to the presence of debt, there are also managerial incentives due to debt, and there are benefits related to agency. There are agency benefits related to debt. Okay, so management entrenchment is a situation arising as the result of the separation of ownership and control in which managers may make decisions that benefit themselves at investors' expenses. So entrenchment allows managers to run the firm in their own best interests rather than in the best interest of shareholders. And the presence of debt reduces management entrenchment. It makes the presence of debt makes the reduces this management entrenchment issue. And since management entrenchment is reduced, no, mas nagiging aligned yung interest ng managers and the shareholders. Okay? So what are the management benefits of leverage? There are three that we're going to discuss. Concentration of ownership, reduction of wasteful investments, and management discipline and commitment. Okay. First is concentration of ownership. So one advantage of using leverage is that it allows the original owners of the firm to maintain their equity stake. And as major shareholders, they will have a strong interest in doing what is best for the firm. Pag kasi nag-issue ng equity ang isang firm, okay, yung ownership interest of the original shareholders will be reduced. Okay? So for example, currently equity is 100 million shares. Rather than issuing debt, nag-issue ng 20 million shares of equity. So dati 100% owned ng old owners. Ngayon 80% owned na lang nila yung company. And because of the reduction in ownership interest, okay, they might be less incentivized, okay, to do what's best for the firm. Okay, kasi 80% na lang ang control dati eh. Lalo na kung for example from 100 naging 51%, right? Practically they only own half the company. So baka wala na akong paki masyado, no? So when firm and also by issuing new equity, firms incurs the agency cost of reduced effort and excessive spending on perks, no? And using leverage can benefit the firm by preserving ownership concentration, no, and therefore avoiding these types of agency costs. Okay. Another benefit of agency benefit of leverage is the reduction in wasteful investments. So one concern always for large corporations is that management has the tendency to make an empire building, you know, or to make large unprofitable investments. Okay. Um, Managers often prefer to run larger firms than smaller ones, and so they are incentivized, no, to increase the size of their investment, but not necessarily profitability of the firm. So managers of large firms tend to also earn larger salaries and therefore garner greater publicity than managers of smaller firms. Okay, debt prevents this from happening because if there is debt, the cash flows of the firm become smaller. Okay, kasi may debt na kailangan bayaran eh. So the free cash flows of the firm become smaller, right? And since the cash flows become smaller, the tendency to invest in wasteful investments also reduces, right? Kasi konti na lang yung pera mo eh. Right? Since konti lang yung pera mo, you cannot invest in big investments in a new building, in a new coliseum, new airplane, or whatever, right? Because your cash flow level is lower than what it was without debt. So therefore, it sort of gives them less opportunity to do wasteful investments because the discipline of paying debt is there. Okay? And because of that, investing in low NPV or negative NPV projects will be low. The chance of that happening is low. Okay. So managers may overinvest because they are overconfident also. So when managers attempt to act in shareholders' interest, they may make mistakes. You know, and thus, how debt um, helps here, you know, is that it makes the cash flow tight. And when cash is tight, managers will be motivated to run the firm as efficiently as possible. Okay. So according to the free cash flow hypothesis, Leverage increases firm value because it commits the firm to making future interest payments, thereby reducing excess cash flows and wasteful investments by managers. Okay? Forces them to be more efficient in operations, therefore increasing firm value. Okay? And lastly, last benefit is management discipline and commitment. Now, leverage may tie managers' hands and commit them to pursue strategies with greater vigor than they would without the threat of financial distress. Okay? If there is the pressure of paying debt, then they will do their best to ensure that the strategies of the firm are implemented properly. Okay, so that they can get the cash flow that they need, so that they can pay debt. So the discipline that is accorded by having debt, or the responsibility of paying debt um, annually or monthly, makes them more financially more disciplined. Okay, so a firm with greater leverage may also become a fiercer competitor and act more aggressively in protecting its markets because it cannot risk the possibility of bankruptcy. So that discipline to management increases firm value because it makes sure that operations are better managed. Okay. So with that, actually, agency costs and the trade-off theory, we can still expand the trade-off theory by considering agency costs, right? Okay. It says here we can say that the value of a levered firm is equal to the value of an unlevered firm plus all the costs and benefits of leverage. Interest tax shield, minus financial distress cost, minus the agency cost of debt, plus the agency benefits of debt. Kung yung financial distress mahirap na i-quantify, lalo na yung agency cost, no? But the idea being that it contributes to uh, to to the increase in the value of a levered firm. Okay, no. So what is the impact? Okay, the impact is still the same. No, meron pa ring optimal capital structure. Now here at this point, value of an unlevered firm. Okay, if we are just looking at taxes, the increase in value of a levered firm should be like this, dotted line. Kung taxes lang sana yung benefit. However, there could be other benefits aside from taxes, kaya mas mataas, and those benefits might be related to agency benefits. Okay, right? And then at some point, it will reduce. The firm value will be reduced. Okay? And actually, pwedeng originally, oops. So originally, ito yung original mong trade-off theory. Okay? Original trade-off theory yung red. Okay? So, it increases with taxes. At some point, financial distress sets in. Okay? But if you include agency cost and agency benefits, mas mataas pa yung value of a levered firm with little leverage because agency benefit sets in. Then at some point, the value of a levered firm decreases because of financial distress cost and agency costs. Okay? If there's too little leverage, no, tax benefits are lost. There might be excessive perks. There could be wasteful investments and empire building. If there's too much leverage, there's excess interest. There is excess financial distress cost, excessive risk taking, and under investment. So that's why the concept of an optimal capital structure is still present. Okay. Now let's discuss an alternative capital structure theory. So we'll just discuss this as an introduction. We'll discuss this further when we go to the articles. Okay. What is an alternative capital structure theory? And this theory does not come from theoretical equations. It comes from the experience in the market, okay, or experience of actual companies. And this is the pecking order hypothesis. Under this capital structure theory, which is pecking order hypothesis, it is the idea that Managers will prefer to fund investments by using retained earnings first or internal cash, then debt and equity only as a last resort. Okay? So parang ang sinasabi under the pecking order hypothesis is um, if firms need to fund something like a capital expenditure, they will prefer to use retained earnings first. Retained earnings meaning internal cash flow. And then kung maubos na yon, they want to fund that they would fund it by debt next. Pag naubos na yung kanilang debt capacity, tsaka lang sila mag-equity. Okay? And that is consistent with what is being seen in practice. No? And I think this chart is also something that I showed. No? So based on the timetable 1990 to 2015 in the US, 100% or more of the capital expenditure funding, so siguro average nito 95%, no, of capital expenditure funding in the United States is by internal equity. Okay? And around, on the average, siguro mga 10%, no? 5% of funding of capital expenditures in the US is by debt. And in fact, negative sa equity kasi mas nagdidividendo sila kaysa nag-i-issue ng equity. Which sort of validates the pecking order hypothesis. Okay? But the theoretical underpinnings of it is not based on value maximization, unlike the trade-off theory. The trade-off theory, ang underpinning nun is we need to maximize firm value, the value of the levered firm. And in doing so, we need to consider the costs related to leverage. And there are positive influences and negative influences to firm value. That's why there's an optimal capital structure. Okay. Here, ang sinasabi, there is no hypothesis about an optimal capital structure. Okay. So while firms should prefer to use retained earnings, then debt, then equity, retained earnings are merely another form of equity financing. Okay. So firms might have low leverage because they are unable to issue additional debt because they rely on internal equity. Okay. So it also explains yung first session natin where I mentioned that literature says the debt to equity ratio of manufacturing firms are low. Okay? And that's probably because they use internal equity first rather than issue debt and rather than to issue outside external equity. Okay? The theory behind it is not value maximization, but the theory behind it is the signaling theory. It's a branch under information economics. Basically, what this is saying is the issuance of debt and the issuance of equity has information content. And since it has information content, okay, the firm will only use debt or equity depending on the information that they want to signal to the market. Okay? So that's why they don't want to use it ng madalas, right? They'd rather use internal equity when no disclosure is required. Okay? Because issuing debt has information content. Issuing equity also has information content. And that may impact the share prices, no, of the companies in the market. So we'll discuss more of that when we go to that article. Okay. Okay. So as I mentioned, the foundation concept is the pecking order hypothesis is the signaling theory of debt. Okay. So the use of leverage is a way to signal information to investors. Thus, a firm can use leverage as a way to convince investors that it does have information that the firm will grow, even if it cannot provide verifiable details. So equity also has signaling implications. Okay. So the two competing theories on capital structure is the trade-off theory and the pecking order hypothesis. And they're based on different economic foundations. Okay. For trade-off theory, this is value, firm value maximization. For the pecking order hypothesis, it's based on information economics. Okay. And another implication is that the trade-off theory has a concept of optimal capital structure, but for the pecking order hypothesis, there is no such optimal capital structure. There is only a hierarchy or pecking order of financing alternatives. Okay, we'll explore more on this difference in the next session. Okay. So, what is the optimal capital structure? The answer is it is not easy to answer. No, because there are numerous market frictions that drive the firm's optimal capital structure. Number one, tax shield. The tax deductibility of interest is a factor to that. Okay. Bankruptcy cost or distress cost. So you have to assess the risk, probability, magnitude, and the discount rate. Okay. Agency costs and benefits should also be considered. What's the behavioral impact to managers? No, and there are negative impacts and positive impact to firm value. In fact, the pecking order hypothesis has no optimal capital structure discussed. No. So determining the optimal capital structure is really an art. There's no computational exercise. There's no go or no go decision. Okay. And as we go along, we will try to define that further. No, we'll do that after the midterms actually. No, to define that further in a practical sense. When is debt available? When is it good to issue debt? No, when is it good to issue equity? And we'll deal with that when we go to the cases of Manila Water and Bond Nisin later on, after the first exam. Okay. So for now, let's accept that there is an optimal capital structure as far as the trade-off theory is concerned, because the consideration of these two items is the trade-off theory. Okay. But so therefore, under this theory, there is an optimal capital structure that we need to find. Okay. And firms within the same industry will gravitate toward that optimal capital structure. Okay. So we'll explore more of this in the next lessons. Okay, that's it. Thank you.